Kimberly-Clark. It's in the green after Barclays upgraded the stock to an overweight, pointing to improving growth, revenue, and a cheaper valuation relative to peers. It is our call of the day. Shares are up 1.6%. Joe?
Sure, I'd love to take that. So this is a stock approaching a 5-year high. It is a stock that I think continues to move higher. Not a particularly large market cap, somewhere around 45 to 50 billion, but it is the beneficiary of the emerging market global story. And one of the things that I will tell you is let us not dismiss the premise that over the coming decades there will be trillions of dollars spent by international and emerging market consumers to have the same things that we want here in the U.S., whether it is the healthcare, the transportation, the energy, the technology. The emerging market consumer will have that. So this speaks directly to it. And I think when you look at specific equity sectors, you could make the argument that this is the one allocation sector-wise that you want to make sure you are not too U.S. specific. If you're too U.S. specific in terms of the revenue, you fall into the Clorox trap, which is 84% U.S. revenue. So you're talking about 46% non-U.S. revenue for Kimberly-Clark. I like that. Even better, Colgate-Palmolive, you're talking about over 70% non-U.S. revenue exposure. Right. So that formula works for me. Overall, I want U.S. revenue exposure. But from a sector basis, consumer staples, I don't want to dismiss their ability to continue to spend.
By the way, as part of this call, Barclays downgraded Clorox, so that's the other side of the coin here. In terms of KMB, though, my fact set tells me it's a 28.5 PE.
And that's
Is that a problem for anybody?
It's a huge problem for me. I would love to own some of these consumer staple stocks, but I never can. And I never can because of exactly that, because the multiples are always too high. They're always too rich. Even at the worst of the year last year, in December, they were trading at like 19 times, 20 times. And they still, even with the emerging markets exposure, this upgrade to revenue growth, it's still low single digit. Earnings growth is still mid single digit. I don't see how anyone justifies those valuations with that limited growth. So when I look across the sector, like, I just got nothing. I've got nothing I can do there. And I've never been able to. I've always wanted to, I can't.
I might just be, maybe that's more of a long only mindset. I think there's plenty of pair trading opportunity, and you can gross up a lot in staples and generate a good spread. So we look for, areas where we can be long one stock and short another. It looks to me like this is a bit of a mean reversion trade on the recent price action where, KMB's been down and it's people, trying to make a short-term trade. So that your fundamental overlay, Joe, is interesting. To me, I think there's lots to do in staples, and I think they generally do well when rates are low, and I think rates probably going to stay low for the foreseeable future. So you probably still have to fight that bias on the valuation and try to at least get some gross exposure there. To me, I think there's lots to do.
With my caveat being, I plan to hold these things for 3 to 5 years. So then that's a very different equation than doing a trade.